Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest on the show, just head on over to missionmatters.com and click on Be Our Guest to apply. All right, today I have Todd Stender on the line, and he's Managing Director over at L&L Capital. Todd, welcome to the show.
Great to be with you, Adam. Thanks for having me.
All right, Todd. So we got a lot to talk about today. So I, of course, want to get into what you're doing over at L&L Capital and also talk about building wealth through net lease real estate investing. But before we get into that, how did you get into this business? How did you get into real estate? Where'd that start for you?
It goes way back, actually. When my father owned 2-family homes in New Jersey, I was the landscaper. So I was cutting the grass, I was trimming the hedges, and then when you'd have a tenant turn, I'd do a little painting. I wasn't a great painter, but the price was right.
What age did you start painting? I'm curious.
Definitely by 10, 11 years old. Definitely.
Oh, man, a man from my own heart. If my dad was hearing this right now, he knows. He had me with the paintbrush. I feel at the same time.
Yeah.
the price was
I was
right,
better with
like
a roller. Yeah. I could roll a wall because there wasn't much damage I could do. But yeah, he did the fine tuning, but all inside. Yeah.
That's great. So continue. So you started pretty young age in the business. You were around it. What happens next? How did you know you were going to get into this?
Well, I went after my MBA. So now really fast forwarding. After my MBA, I went to Wall Street. And from Wall Street, covering stocks as an equity analyst. And I covered bank stocks, insurance stocks, but also real estate investment trusts, or REITs. And so that's where I really started to get into the commercial real estate space, but covering from the stock market side. So as an analyst, digging into the numbers, conveying good ideas, hopefully good ideas, to our wealth advisors and then institutions. And so that was in LA. And then from LA, moved back to the New York area, and I worked in New York for a while. And so these were all equity analyst positions, again, leaving banks and insurance behind and strictly dealing with REITs. And so that's where I really cut my teeth on the commercial side. And as long as you're an equity analyst working for large investment banks, you also get the opportunity to work on IPOs. And so I was kind of the gatekeeper doing the due diligence on any private company that wanted to go public. And so that was interesting. You got to see private companies.
Just kind of like roughly what years were they?
Yeah, so post GFC, so after the global financial crisis, I was a senior analyst starting in 2009.
Oh, wow.
So as you see banks and real estate companies kind of emerging from that.
Interesting time to be in the market. That's interesting, especially in your seat. Go ahead, please.
Yeah. So, So, 09, 10, 11, 12, you started to see the markets come back. You started to see private companies looking to raise capital, and what better way than the public markets at the time. The private markets weren't as accessible, but a really interesting period. So I got to cover healthcare REITs, self-storage REITs, and then triple net or net lease REITs. And so that's what I really got to see, a variety of private companies, public companies in the public market. So it was really a unique period, which was great.
Yeah. What was it like? I'm just curious about being in your seat or in those days, because this is still, 2009, 2008 just happened. There's everybody, people are still really feeling it. Everything from obviously the market's feeling, but the professionals that were maybe working with you and colleagues, things like that. It was a tricky time. What was it like being in that role?
It was tough because investors were cautious. They'd gotten burned. Real estate companies
had loans are fresh at that point. Yeah.
The debt that was coming due during 2008, 2009, and maybe they couldn't refinance out of it. So there were some REITs that did make it out. And then there were a lot that did, thank goodness, but maybe they raised really expensive capital. And so now they had to refinance that. But also smaller companies looking for an exit was difficult. And so we were tough. We were scrutinizing the private companies that wanted to come public. But things are improving. The risk appetite from investors improved into 2012, 2013, and rates were low. Interest rates were low for so long. That just kind of fueled a little more activity. And then then it really picked up. 2015, 2016, you saw a lot of the existing REITs raising a ton of capital, and the more money they had, that means they can consolidate commercial real estate and just buy more. So I got to be a part of it. So it was a pretty exciting period. In my world wasn't that exciting. So you think about some of these property types, and I was even covering mobile home parks, which don't sound exciting, but the growth was so robust.
Yes. Oh my gosh. Yeah. I got some friends that they started their career there like out of college, and boy, they were way smarter than me.
It wasn't glamorous, right? Yeah. But great returns. Really, really good real estate.
Yeah. So you obviously had carved out an amazing niche through your career in these early years on covering REITs, and even before that, obviously with the tactile experience of being in the homes and things like that. So L&L Capital, maybe start there and give us a little bit of background on the firm and what you do today.
Sure. So L&L Capital, we're private credit, specifically in the net lease space. And net lease is a niche within commercial real estate. And so the name net lease in isolation doesn't do much to describe it, but it is commercial real estate. You could see it in retail, office, industrial, see it in data centers. So it really relates to the lease itself. And the lease is just like any other commercial real estate lease where you've got a tenant and a landlord, and the tenant pays rent. Typically long-term. So not like an apartment where you might see a 6-month or 12-month lease. Net leases, especially triple net leases, you're talking now 15 years. So really long-term leases. And the unique part about it is your tenant picks up most, if not all, of the operating expenses. So literally, they're paying the property tax, they're paying the utilities, they're paying the insurance policy, and they're maintaining the building. They're doing it all. So it creates a really unique passive income stream to the landlord. And so you see this a lot with fast food drive-thrus. So we call them quick service restaurants. It could be 7-Elevens with gas. Could be gas convenience, car washes, dollar stores. Very, very common in commercial real estate, particularly in retail. And so it's a niche. So you don't really see it in apartments, but you'll see it in these other property types. And so that, to make a long story short, is what L&L does, is we make construction loans to preferred developers who build these. And so if you're a preferred developer of Chipotle, Chick-fil-A, Burger King, 7-Eleven, you're building many of these over the course of a year, and that's where we come in. We might make you a construction loan if that builder has a lease in place. They have to have a lease in place, and then we'll make that loan. We do bridge loans. We do mezzanine financing. And so we're in the private credit space, but only for net lease.
So you obviously, with your background and experience, I mean, you could have chosen many different niches to go. Like, what attracted you to this particular real estate niche the most?
Well, what I appreciated with my background in the stock market, a volatile stock market, often the case, is the predictability and stability of net lease. And so you've got this 15-year lease. Your tenant is in place. You know what the rent's going to be for the next 15 years. The rent goes up definitely, most often annually, sometimes every 5 years. So you'll probably get either 2% every year or 10% every 5 years. And so by the rent going up, it keeps up with inflation. And so I preferred that stability and reliability, and there's tons to buy. So there's a huge opportunity in the U.S. to consolidate this real estate because there are so many properties that you and I and everyone listening drives by every day. Because these tenants, these large national tenants, typically don't own the real estate. They just lease it. And so I love that unique opportunity set where people may not play. You know, I think multifamily is a very crowded space. I think there's a lot of investors chasing multifamily, but maybe not so many in net lease. So that's what I like about it.
Who would you say or where does this fit in someone's portfolio? Like taking kind of that lens from it. So talk to me from like the investor side of things for now.
Well, I think it fits. I think most investors, particularly individual investors, look at the world or their portfolio in a pie chart. And if you think about, your traditional 60-40 portfolio, 60% stocks, 40% bonds, there's now a sliver that's emerging that people recognize you might need some alternatives, alternatives outside of the volatile capital markets. And so that's where, call it 15 20%. Tiger 21 is an organization of high net worth individuals. They're kind of up around 25% alternatives. And the bulk of that is real estate. And so I think if you're looking for a little more stability and predictability, that is better than a bond because you've got inflation protection with your commercial real estate, especially net lease. I think it fits well in there to provide current income because you've got a tenant in there, so they're going to pay rent. And it's very tax efficient. You've got that nice depreciation that you can use. So that fits well, I think, for investors.
Yeah. What area? I know you mentioned the types of investments. I'm curious about geography. So are you geography agnostic in terms of the United States? Does it depend on the state it's the deal, or are you only in certain regions? Like, give us a little bit of that piece of the story.
So great point. We're agnostic is the short answer. We're looking at deals in all 50 states. I would say just that growth, that population growth that we saw coming, during and after COVID really highlights the Southeast. And so the U.S. population migrating from my home state of New Jersey and the New York area down to Florida, for example, and everywhere in between. And particularly in Texas, I live in California now, and so you're seeing companies migrate from California to Texas, for example, driven, of course, by, the beneficial state income tax. That goes so Florida, Tennessee, Texas. But no, we're lending and making investments all over the U.S.
And in terms of how people can get involved, like, do you take on outside capital from accredited investors, or is this only an institutional play? Like, talk to me about that makeup a bit.
Sure. Primarily institutions. And so what resonates well with insurance companies and pension funds, for example, are their long-dated liabilities. And so if you can match those liabilities that those insurance companies have with a long-dated lease, in that lease, a 15-year lease, and they can match that asset liability, that works really well. So that's our predominant investor, but certainly high net worth, family offices, we cater to those groups as well.
Yeah. So I'll put the timestamp on this one. It's March 26th when we're recording this, so we're going to blink and we'll be in Q2. I'm just curious, what kind of things are happening in the walls of L&L Capital? What kind of things is the team talking about?
I think reaching a broader investor base, certainly U.S. investors, Canadian investors. I was down in Sao Paulo, Brazil 3 weeks ago, meeting with family offices, high net worth investors, institutions. So Leste Group is our sponsor. They're based in Miami. They have a presence and an origin in Brazil. And so we're kind of expanding our outreach, and that's where I come in with capital formation and meeting with investors internally. We've been quoted more lately in magazines. We just had a presence at the iConnections conference, which is an alternative investment conference in Miami. So I think a little more visibility at the firm. The timing sounds pretty good. We've just coming out of a tough commercial real estate market over the last couple of years. We need interest rates to come down a little bit more, but they are gradually. And that's a good time for us to be putting capital to work. So internally, we're reaching out a little bit more and getting a little more exposure.
Amazing. Todd, this has been great having you on the show today and learning more about what you're doing over at L&L Capital. And thanks for the insights here. I learned a lot. I'm sure my audience did as well. That being said, if somebody wants to follow up, connect with your team, continue the conversation, what's the best way for people to connect with L&L Capital?
Well, thanks, Adam, for having me. I would say they can email me directly at Todd, Todd, Stender, Stender, at Leste, Leste.com. You can certainly visit our website. It's lnlcap.com. That's probably the best.
Fantastic. For everybody listening, just so you know, we'll definitely put some links in the show notes so you can just click on the links and head right on over. And speaking of the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. Yes, you heard me correct. Each and every day we're bringing you new content, new ideas, and hopefully new inspiration to help you along the way in your journey. So hit that subscribe or follow. We got some great interviews coming up, and we don't want you to miss a thing. Todd, appreciate you coming on. Thanks again.
Thanks, Adam.